Hi everyone. Today we're going to talk about a fascinating but risky trading strategy, short selling. You've probably heard about it in the news during stock market dramas, but what does it actually mean? Let's break it down. Short selling or shorting is when a trader sells a stock they don't actually own, hoping to buy it back later at a lower price. Essentially, it's betting against a stock. If the stock goes down, the trader profits. But if it goes up, the trader can lose money, and those losses can be unlimited, since stock prices can rise indefinitely. How does it work? Here's the process step by step. 1. The trader borrows shares from a broker. 2. They sell those shares in the open market. 3. Later, they buy the same number of shares back. This is called covering the short. 4. They return the shares to the broker. Profit happens if the buyback price is lower than the selling price. Losses happen if the buyback price is higher. Let's use Netflix as an example. Suppose a trader believes Netflix at $500 per share is overvalued. They short 100 shares. If the price drops to $400, the trader buys back at $40,000 and makes a $10,000 profit. But if the price rises to $600, the trader must buy back at $60,000, taking a $10,000 loss. This shows how short selling is a high risk, high reward strategy. So why do traders short sell? Speculation to profit from expected price declines. Hedging to offset risk, for example, shorting an index to protect a portfolio. Arbitrage to take advantage of mispricing between related securities. In other words, short selling isn't always about making a bearish bet. It can also be a strategic tool. But let's not forget the risks. Unlimited losses if prices skyrocket. Margin requirements since brokers need collateral. Short squeezes where rising prices force many shorts to cover, driving prices even higher. Borrowing costs, especially for hard-to-find stocks. These risks make short selling much more dangerous than simply buying a stock. To wrap up, short selling is a way to bet against a stock, but it comes with big risks and requires careful management. It can be used for speculation, hedging, or arbitrage, but it's not for the faint of heart. This concludes our discussion about short selling. See you at the next lecture.